First, our top story this half an hour. Trade tensions are rattling global markets. Futures were indicating a sharp sell-off at the start of trading this morning after the president asked his U.S. trade representative, Robert Lighthizer, to come up with a new list of products totaling $200 billion that he could slap a 10% tariff on. He's threatening a new round of tariffs on China, sparking fears of an all-out trade war. They seem to be affecting China more than the U.S., with the Shanghai Composite tumbling almost 4% today, closing at a two-year low. Joining me right now is Allianz Chief Economic Advisor, Mohamed El-Erian. Mohamed, good to see you this morning. Thanks so much for joining us.
Thank you, Maria.
Your takeaway on markets this morning.
So markets until now have been comfortable with the notion that the trade tension were a means to a better end, that is fairer and free trade, rather than an end in itself, which is trade war. Today, they're a little bit more nervous. I suspect that at the end of the day, we're going to see that all these trade tensions will result in fairer but still free trade, but the uncertainty is higher.
So given how much the U.S. imports from China, do you see China coming back to the negotiating table sooner rather than later? I mean, already the U.S. has a deficit with China, $375 billion. So for them to be putting tariffs on things, it's only making that relationship worse.
So the U.S., in a way, outperforms in whatever scenario we end up. The question is, what does the global economy as a whole look like? So the house is solid, the neighborhood is uncertain. Why does the U.S. outperform? Well, if we get fairer and free trade, this will help U.S. growth. If we slip into a trade war, the U.S. is a relatively closed economy, and therefore the U.S. will get hurt less than others.
Yeah.
So the markets are being very rational in saying the U.S. outperforms in either scenario, but the overall level of asset prices is very different.
So when you first sat down, you said, look, I think at the end of the day, basically calmer heads will prevail, and we'll likely see fairer trade among the U.S. and China. Is that basically the mentality on Wall Street, do you think? Do you think that most people today have gotten more comfortable with the president's approach, the way that he may very well be playing poker, if you will, seeing what would stick in terms of pushing, even if it's allies, around when it comes to trade and getting the U.S. in a better position? Or do you think things like this are surprising markets? Because, yeah, we have a 375-point sell-off today, but I'm wondering if this is just another day where markets are betting on this president doing his role in terms of getting a better position for the U.S.
So I think it's going to be that view will prevail, and for three reasons. One, they've seen this before,
right.
So it's not a new movie. Second, the U.S. has, and other countries have genuine issues. Intellectual property theft, that's a genuine issue. Non-trade tariff, like joint venture requirements, that's a genuine issue. And the third is that the U.S. has a stronger bargaining position. I think, Maria, the reason why you're seeing nervousness is because that's an incremental uncertainty. Already, Wall Street is dealing with three transitions in monetary policy, and we saw that with the Fed last week. In volatility regimes, higher volatility or more normal volatility is returning to the market. And then there's also uncertainty about the global and synchronized pickup in growth. So what you're getting is all these moving pieces and yet another one on top. But at the end of the day, I think markets take the approach that you cited, which is we've seen this before, and they are hopeful that it will iterate to a better outcome.
Yeah, no, that's what I was expecting. But let me ask you this, because there's another narrative going around that things are going to slow down, Mohamed. I mean, we're in year 9 or year 10 of a recovery in this economy. And even though we got a very good retail sales number out last week, there is a feeling among some that as the Fed raises rates, the consumer is going to slow down, oil prices where they are, also cutting into the consumer. Do you believe things will slow down in the coming years, economically speaking?
So away from the U.S., things are slowing down. And that's because their growth hasn't been policy-induced. It's either been a natural healing process in Europe. So you get out of the hospital and you can walk, but you can't run. Or alternatively, it's been a bounce back from a shock. In the U.S., it's been policy-driven. And what we're seeing are three engines of growth coming on at the same time. The consumer, because the labor market is strong. Business investment. And thirdly, government spending. And all three are coming together. So I think what you're going to see is actually an acceleration in growth on an annual basis for a while. And then the question mark will be how long can the U.S. be the good house in a challenged global neighborhood?
So what do you want to do then as an investor? You wake up this morning to see a sell-off of almost 400 points on the Dow. I know you're not a short-term thinker, you're a long-term thinker, but what should investors be looking at or approaching? How do they approach this market?
So here's the one good thing, and that is whether you believe that the trade tensions are a means to a better end or whether it's an end in itself, which is a trade war. Here are three things that I think largely persist regardless of where you are. One is don't get shaken out of names, good names, strong balance sheets, strong business models, and there's many of those. Two, favor U.S. name relative to the rest of the world. The U.S. will continue to outperform. And then three, look to exploit overshoots. There are inevitable technical overshoots. You know that, Maria. The market technically overshoots on certain names. That's a great investment opportunity for people who have a long-term horizon and can underwrite volatility.
Speaking of overshooting, is the Federal Reserve going to overshoot, Mohamed? Your take on the central banks of the world tightening up. The Fed was pretty positive last week. Jay Powell saying things are going really well. Are 4 rate hikes appropriate for the year, or is the Fed about to blow it and cause a recession?
I think 4 rate hikes for the year are more the risk than the baseline. I think the baseline is 3 rate hikes for the year. But the Fed is confident about the domestic economy, about the growth outlook, and the Fed believes that this economy is strong enough to overcome headwinds from abroad. But I think at the end of the day, it's going to be 3 hikes this year, not 4.
What about the ECB, Mohamed? Your take on the ECB meeting last week?
Much trickier, and the ECB delivered quite a delicate balance. On the one hand, confirming that they're looking to exit their QE. On the other hand, saying, but don't worry, we're not going to raise interest rates very fast. It's a very delicate balance. I think if you ask me about central banks in general, Maria, the Fed can deliver a beautiful normalization. It can normalize policy without derailing economic growth. The big question mark is what happens when not 1, but 3 central banks, the Fed, the ECB, and the Bank of Japan, all get into the business of exiting from unconventional policy. And that's the uncertainty that markets are trying to price in.
Right. Looks like that's where we're going, although we'll wait to hear more from the BOJ. Mohamed, it's always a pleasure to see you. Thanks so much.
Thank you, Maria.
Mohamed El-Erian joining us there.